Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over 2023 October-November paper 1-2. This is a multiple choice paper which consists of 30 questions and each of them will be of 1 mark. The total time limit given for this paper is 1 hour. So in this video as well, we'll be attempting to complete this paper under 1 hour. So without any further delay, let's get started. For the first question, which list is a long-term source of additional funds for a limited company? So we're looking for a long-term source. So it should be used by our limited company for more than a period of 1 year. Then we're looking for additional funds. It means that we should not be looking for the funds that already existed within the business. For the first option, we have a bank loan. Remember that bank loan is a long-term source because we classify it as a non-current liability, and this is also additional fund because bank loan will be acquired from bank, so we're essentially receiving the funds from some outside party. So this one is correct. Then we have bonus issue of shares. So remember that bonus issue of shares will be funded by the reserves of the company itself. Although it will increase the number of ordinary shares, we will be utilizing our own reserves. So in this case, there is no additional funds. So this will be incorrect, which is why option A will be incorrect. For the second one, we have bank loan, which is correct. Then we have the leasing of premises. Remember that premises is our non-current asset, which means that it will be utilized by the limited company for a period of more than 1 year. And we're talking about leasing, which means that we are essentially utilizing the premises that will belong to some other party. So this is definitely additional fund, which is correct. Then we have rights issue of shares. Rights issue is provided to the existing shareholders, and those shareholders will provide additional funds in order to acquire those shares. So this will definitely increase our capital, right? And capital is definitely long term. And talking about additional funds, since the company will be receiving additional money from the existing shareholders, this will classify for what we're looking for in this case. So the correct option will be option B. Let's look at the remaining options as well. For C, we have bonus issue of shares. This will be incorrect for the same reason given for option A. Then for D, we have debenture issue. Remember that debenture is a non-current liability, which means that this is long-term in nature. And this is also additional fund because debenture will be acquired from some outside party. So this is correct. Then we have rights issue of shares, which is also correct. Then we have the trade credit. So trade credit will be incorrect in this case because trade credit is just the additional period provided by the supplier for us to pay them back, right? So you can basically associate it to trade payables, and since trade payables is short term in nature, this won't qualify for what we're looking for in this case. That's why option D will be incorrect as well. Which statements describe advantages of maintaining full accounting records? The first statement is a more complete assessment of business performance is possible. This is true because while maintaining full accounting records, we would have to record each and every transaction, right? So it means that anyone looking for evaluating the business performance can take a look at all of the transactions and figure out how each of those transactions can affect the business performance, which is why statement 1 is correct. Then bookkeeping costs are minimized. Remember, we're talking about maintaining full accounting records. It means that the bookkeeper will have to go through each and every transaction and post them in their relevant accounts. And that would be time consuming, which is why the bookkeeper would have to be paid an extra amount. So the cost will not be minimized, it will be the opposite. That's incorrect. Then for the third one, business managers can make more informed decisions. That is true because full accounting records will have each and every transaction. So before making a decision, they can look at every transaction that the company has made and which course of action would present the best result for the company, which is why statement 3 will be correct. Then for the fourth one, financial statements will be free from errors and inaccuracies. So although we have maintained all of the transactions and recorded it in the relevant account, we cannot be sure that those accounts are free from errors and inaccuracies because human errors can always be present. There can be error of original entry or there can be error of transposition, and that will be made by the bookkeeper. So maintaining full accounting records will not ensure that our financial statements will be free from errors and inaccuracies. So statement 4 is incorrect. The correct answer we're looking for in this case is 1 and 3, which is given by option A. For the third question, Maria recorded a check of 475 received from Josh, a credit customer. Josh had deducted a 5% cash discount. So we're talking about cash discount in this case, which will be recorded in our books of accounts. The check has now been returned as dishonored. What is the correct entry to record the return of the check in Maria's books? Okay. So there was a 5% cash discount, and this is the amount after applying the 5% discount. The first thing that we can do is figure out the amount before the discount. So amount before discount multiplied by the discount rate will result in the amount of 475. That's what Josh paid to Maria. Now the original amount would be 475 divided by 1 minus 5%, which will result in 500. And now the discount in this case would be the difference between our original amount and the amount that was actually paid, right? So the discount will be 500 minus 475, which results in 25. Okay, and in this case, we're talking about Maria's books, right? And this discount was received by Josh from Maria, which means that for Maria's books of accounts, we can treat this as discount allowed. Since we're looking for discount allowed, any option with discount received will be incorrect now. So that will be option A and option B. Now let's focus on the return of the check. So this just means that Maria will now be paying the check back to Josh. So Josh will be receiving the check in this case, and any receiver will be addressed as a debit side in case of a journal entry, right? Which means that Josh will be recorded on the debit side with the full amount of 500, and now this 500 is funded by two different headings. The first one is the discount allowed of 25, and the second one is the 475 that was actually paid by check, right? Those two headings will go on the credit side. So we're looking for bank on the credit side. This will contain the amount of check, which was a 475. Then we're looking for discount allowed, again on the credit side of 25. Now we have 500 on both our debit side as well as the credit side. So this is the correct answer we're looking for. Josh on debit side and bank and discount allowed on credit side. So the correct answer will be option D. Now for our fourth question, a business purchased a shop and incurred the following costs. In this case, we need to figure out the total capital expenditure. So capital will be non-recurring in nature. So we're looking at events which would not be frequent within a business. The first one is purchase price of the shop. So purchasing of the shop is not a frequent event that a business indulges in, right? It can be classified as our capital expenditure. So we can start with the amount of 680,000. And this is the capital expenditure because this is not the day-to-day activity of the business. Then the second one is legal fees incurred in the purchase of the shop. Since we've already concluded that the purchase of the shop is not a regular event, we can also conclude that the legal fees will also be non-recurring in nature, because legal fees will only have to be paid when we are purchasing the shop. And since we've concluded that the purchase of the shop is only done once, the legal fees will also be paid only once, right? So this will be classified as capital expenditure as well. Let's have the amount of 7,200. Then we have the cost of initial inventory. Remember that inventory are the goods that will be purchased by the business in order to resell it again, right? So that's the major operation of the business itself, which means that the company will have to buy inventory as soon as their stock finishes, which means that this is of recurring nature. So this is not capital expenditure, this is revenue expenditure. So we should not be adding this amount of 12,500. Then we have the cost of installing air conditioning. Remember that we only have to install the air conditioning once, right? It will function after it has been installed. So the installation should not be done time and again, which means that this can be classified as non-recurring in nature. So we can classify it as capital expenditure. Let's add the amount of 47,300. Now this will give the total capital expenditure to be of 734,500. This is the answer we're looking for, which is given in option C. Now for question number 5, a used motor vehicle was part exchanged for a new motor vehicle, and the balance of the purchase cost of the new motor vehicle was settled by check. So we purchased a new motor vehicle, and part of it was paid by check, part of it was paid by part exchange. Now, what were the entries to record the part exchange value? So we're not focusing on the check payment, we're only focusing on part exchange. Remember that we purchased a new motor vehicle, which means that non-current asset is increasing, and whenever asset increases, that will go towards the debit side, which means that we're looking for motor vehicle being debited. That is given in option C and D. And we are focusing on part exchange. So part exchange can just be understood as the company disposing an old motor vehicle and exchanging it for a new motor vehicle. So in this case, motor vehicle is being reduced, right? Because the existing motor vehicle is now disposed, and that will be termed under the heading of disposal. So we're looking for disposal on the credit side. That is given in option A and D, and the correct one for both debit side and the credit side is given by option D. For the sixth question, a non-current asset of a business cost 300,000 in 2021. It is depreciated using the reducing balance method at the rate of 40% per annum. A full year's depreciation is provided in the year of acquisition, but none in the year of sale. The financial year of the business ends on 31st December. In 2023, the item was sold for 150,000. So that's our sales proceeds. And disposal costs of 1,500 were also incurred. What was the profit on disposal? Okay, so remember the question already indicates that there was a profit on disposal. And profit occurs whenever we receive a higher amount than what we anticipated for, right? In this case, the sales proceeds was higher than the net book value. So the profit on disposal will just be sale proceeds minus the net book value. And we also have disposal cost. So we need to subtract that as well. We have the sales proceeds as well as the disposal cost, but we should also figure out our net book value. Alright, in this case, we know that it was purchased in 2021, and we also know that a full year's depreciation is provided in the year of acquisition, but none in the year of sale. And the item was sold in 2023. Okay, I'm just going to create a timeline here. This is the year 2021. This is the year 2022. This is the year 2023, when the non-current asset was disposed, and we were told that no depreciation should be provided in the year of sale. So we do not need to calculate it for the third year. Let's start with the depreciation for first year. Since we're talking about first year, even though we are using reducing balance method, there will be no accumulated depreciation. So we can just multiply the cost by our rate of depreciation. So that will be 300,000 times 40%. This results in the amount of 120,000. Now for the depreciation in the year 2022, this 120,000 will act as the accumulated depreciation. So our net book value will be 300,000 minus 120,000 multiplied by the rate of 40%. This results in the amount of 72,000. Now let's calculate the accumulated depreciation. That will be the depreciation charge in the year of 2021, which is 120,000. Plus the depreciation charge in the year 2022, which was 72,000. This results in the value of 192,000. Now we have the cost as well as the accumulated depreciation. So the net book value will just be the difference between these two amounts. So 300,000 minus 192,000, which results in 108,000. Now let's input the values in this equation. The sales proceeds given was of 150,000. The net book value is 108,000. It's right here. We calculated it just now. Then the disposal cost was of 15,000. This results in the value of 27,000. This is the answer we're looking for, which is given in option A. Now for the seventh question, a business received 100 cash from a credit customer in settlement of a debt. When recording it, an error of commission was made. An error of commission just means that the correct amount was recorded on the correct side but of an incorrect account of the same class. And in this case, we're talking about a credit customer settling his debt, right? So we're looking for the incorrect account of the same class for this transaction. Which statement about the debit and credit columns of the trial balance is correct? Okay, we're talking about the error that will be reflected in trial balance, but remember that we're talking about error of commission, which will not be disclosed by trial balance because we have entered the correct amount on the correct side, but only of the incorrect account, but we're still talking about the same class, which means that the debit side and the credit side should have the same total for the trial balance. So that's the answer we're looking for. We have the total of the credit column was 100 higher than the total of the debit column. This is incorrect because we have already concluded that the debit and the credit side should be equal. Then for second one, the total of the debit column was 100 higher. Again, this is incorrect. For the third one, the totals of both columns were the same as if the error had not taken place. This is the correct answer we're looking for because this is error of commission, which will not be disclosed by the preparation of trial balance. Let's take a look at the first option as well. The totals of both columns were understated by the same amount. That's incorrect because they should be the same as if the error had not taken place, because the correct amount was entered on the correct side but only under the wrong account of the same class, which is why option D will also be incorrect. Now for question number 8, a company's trial balance includes a suspense account. It was found that only errors were discounts received of 240 and discounts allowed of 312, which had both been entered on the incorrect sides of the respective ledger accounts. Okay. What is the double entry required to clear the suspense account balance? Okay, it would be easy to get the answer for this question by preparing the trial balance and rectifying those errors within the trial balance itself. Now, the first error in this case is the discounts received of 240 being posted on the opposite side or the incorrect side. And in this case, we're talking about discount received, which is income, which means that the correct side for this 240 would be the credit side. Now, if we record the 240 once on the credit side, it would just get cancelled out with the previous amount entered on the incorrect side, which is the debit side. That is why we need to enter it twice, so that once it gets cancelled out with the previous amount and once it shows the correct amount of discounts received. So we need to record 240 twice under the heading of discounts received, and the total would just be 480. Now the second error was for discounts allowed, and it is the same thing, right? So discount allowed is an expense, which means that 312 should have been recorded on the debit side. Now if we record it only once, it would get cancelled out with the previous error, which is why we need to record it again. And both of these will be under the heading of discounts allowed, and the total in this case would be 624. Now any difference would just be entered as part of the suspense account. In this case, the debit side is heavier, so the suspense account will have the value of 624 minus 480, which results in 144. So the correct answer we're looking for is 624 on the debit side under the heading of discounts allowed, then 480 on the credit side under the heading of discount received, and 144 on the credit side under the heading of suspense account. Okay, for the first one, we have discount allowed on the debit side, discount received and suspense on the credit side, but see, the amounts are different. So option A will be incorrect. For the second one, we have discount allowed on debit side, discount received on credit side, suspense on credit side, with the correct amounts of 624, 480 and 144. So this is the correct answer we're looking for. Now for question number 9, which statements describe the benefits of preparing a bank reconciliation statement? Okay, for the first statement, checks the accuracy of transactions recorded on the bank statement. This is correct because any transactions that has been missed by bank statement will be entered as part of the bank reconciliation statement under the heading of unpresented checks and outstanding deposits. So statement 1 is correct. For statement 2, ensures that cash in the till agrees with the total of the cash column in the cash book. Okay, so cash in the till is just the cash in hand for the business, right? And we're talking about the total of the cash column in the cash book, but it does not mention the bank statement at all, which is why this is incorrect, because the bank reconciliation statement just reconciles the bank balance as per the bank statement and the total of the cash column in the cash book, right? So option 2 is incorrect. Then eliminates the possibility of fraud by members of staff. This is incorrect because bank reconciliation statement only reconciles the transactions that has been missed in our cash book and the transactions that has been missed in our bank statement. But it does not ensure that any fraud will be detected, right? So statement 3 is also incorrect. Then for the fourth one, it ensures that the trial balance and the financial statements contain an up-to-date figure for cash at bank. This is true because bank reconciliation statement will just provide the updated bank balance or the cash at bank by adjusting the unpresented checks and outstanding deposits. So statement 4 is also correct. We're looking for 1 and 4, which is given in option C. For question number 10, a trader's cash book shows a debit balance of 12,460 at 30 April. We're talking about cash book in this case, and debit balance will be a positive balance. Bank charges of 4,500 have not been entered in the cash book. A check for 14,470 received from a credit customer and a check for 1,740 paid to a supplier appear in the cash book but not on the bank statement. What is the balance shown on the bank statement at 30 April? Okay, so in this case, we have to prepare the cash book as well as the bank reconciliation statement. Let us first prepare the cash book. We have a positive amount of 12,460, which means that will go on the debit side, because the debit side in the cash book will represent all of our income. The credit side will represent all of our expenses. So that's 12,460. And the bank charges had not been entered. Bank charges is an expense, which is why 4,500 should go on the credit side. Now let's figure out the updated cash balance as per our cash book. That's 12,460 for our total. And for the updated balance, that will be 12,460 minus 4,500, which results in 7,960. Now, let us create our bank reconciliation statement. So we can start with the cash balance as per bank statement. Then we just have to subtract any uncredited checks. So these are the expenses not yet recorded within our bank statement. Then we need to add outstanding deposits. These are the incomes that are not yet adjusted within the bank statement. Then we get the cash balance as per cash book. Now it's quite easy, we can just enter the amounts. We already know that the updated cash balance as per the cash book is 7,960. We're trying to figure out the balance shown on the bank statement. So we're trying to figure out this amount. Now, uncredited checks are any expenses that are yet to be recorded, right? And in this case, we are told that a check for 1,740 paid to a supplier, which means that this is an expense, appear in the cash book but not on the bank statement. So 1,740 will act as our uncredited check. We need to subtract it. Then we have outstanding deposit right here. A check for 14,470 received from a credit customer. Received indicates that this is an income which should be added. So 14,470. Now we're just trying to figure out the balance shown on the bank statement. Now let us create an equation. So balance shown on the bank statement minus 1,740 plus 14,470 will be equal to 7,960. Now the answer that we're looking for will be 7,960 plus 14,470. Sorry, that should be minus 14,470 because this goes on the other side. The sign will change, plus 1,740. This results in the amount of negative 4,770. Since we're talking about a negative balance in this case, remember that for our bank statement, the income will go on the credit side, the expenses will go on the debit side. Since we're talking about a negative balance, this can be classified as expense, which means that it will be shown on the debit side. So the correct answer we're looking for is 4,770 debit, which is given in option B. For question number 11, a credit customer gave cash to a sales ledger clerk in part settlement of a debt. The clerk was dishonest and kept the cash for himself. He entered the receipt in the customer's sales ledger account but made no entry in the cash book. What caused the theft to be discovered? Okay, so in this case, what we've done is a credit customer paid us, right? So the payment was received and we were told that he entered the receipt in the customer's sales ledger account. So the sales ledger account was correct because the correct amount was entered there, but the payment should also have been recorded in the cash book but made no entry in the cash book, which means that the cash book balance will be incorrect. And remember, cash book is the book of prime entry which will be used while creating our sales ledger control account. And remember, the balance on the sales ledger account and the sales ledger control account should be correct, right? But if one entry has been recorded in the sales ledger account and the same entry has not yet been recorded in the sales ledger control account, that means that the balance on these two accounts will be different. And that would cause the theft to be discovered. So that's the answer we're looking for in this case. For the first one, we have a bank reconciliation statement. That's incorrect because we're looking for sales ledger control account. For the second one, a sales ledger control account reconciliation statement was prepared. This is true because the balance as per the sales ledger control account will not be equal to the balance as per the customer's sales ledger account. This is the correct answer we're looking for. Let's take a look at the remaining options as well. A statement of account was sent to and checked by the customer. That is incorrect because the customer would not bother anymore with the business once they've already made payment for the credit purchase, right? Then for the fourth one, a trial balance was extracted from the books of accounts. The trial balance would not disclose this information because no entry had been made in the cash book, and cash book is the book of prime entry. So there is no entry to verify the error from our trial balance. This is incorrect. Now for the 12th question, the following information is available. We have the balance of trade receivables at the start of the year, balance of trade receivables at the end of the year, trade discount given to credit customers, cash discount taken by credit customers, irrecoverable debt written off during the year, increase in allowance for irrecoverable debt for the year, then cash received from credit customers during the year. Okay, we just need to figure out the total value of credit sales for the year. Okay, that's easy because we have all of the information right here. We can start with the cash received from credit customers. So that will be 516,000. And this will be added while calculating the credit sales because that's the amount received from customer for the sales that we made during the year or in the previous year as well, because this is received from credit customers. So credit customers could also be paying for the credit purchases made in the previous year. Then we need to adjust the trade receivables balances at the beginning of the year and end of the year. For the opening balance, we will subtract it. That is because this 48,000 was the credit sales made in the previous year, but we received the payment during this year. So that 48,000 is also included as part of the 516,000 received during the year. But we're only calculating the credit sales for the current year, not the previous year, which is why we should not be including this value. That is why we're just going to subtract the 48,000. Then for the end of the year, we will add this value of 65,300 because the credit sales was made during the year, but we are yet to receive the amount from the customers. Regardless, the sales was made during the year, which is why we need to add it. So that will be plus 65,300. And remember, trade discount will not be recorded in our books of accounts. So we can completely ignore this 3,000. But we have the cash discount taken by credit customers as well. Now, this 4,500 should be included as part of our credit sales because we have to show this amount within the credit sales. And later on within our statement of financial position, we subtract the same amount as part of the discount allowed. So we just have to add the 4,500 first. Then we have the irrecoverable debt written off during the year. Again, this is the bad debt. So this amount of 6,200 will not be received by the business anymore. Regardless, the goods worth 6,200 was sold to a credit customer, right? Which is why this 6,200 should be added while calculating the credit sales. This will give the value of 544,000. This is the answer we're looking for, which is given in option B. Now for question number 13, at a business's financial year end, there were expenses owing, expenses prepaid, income owing, and income received in advance. How will the ledger account balances brought down at the start of the new financial year appear in the general ledger? Okay, so for this one, we just have to classify whether the given headings would act as our current assets or current liability. Because whenever we talk about assets, the opening balance or the balance brought down at the start of the new financial year will be shown on the debit side. Whenever we're talking about liabilities, the opening balance will be shown on the credit side. Okay, for the first one, we have expenses owing. It just means that we are yet to pay these amounts, which means that we are liable to pay this amount. So this is our liability, and expenses owing should be shown on the credit side. Then we have expenses prepaid. It means that we are yet to use the services for the amount that we have already paid. So we are yet to receive those services, receivables, which is why these can be classified as asset. So we should be looking for this heading on the debit side. Then we have income owing. So income owing just means that we have already provided the services, but we are yet to receive the payment for it, which means that this can be classified as receivables, so an asset. This will be on the debit side. Then we have the income received in advance. So we have already received the payment, but we are yet to provide the services for it. So the provision of services is basically that the company will now be liable to provide these services. So this is now a liability which will be shown on the credit side. So for the debit side, we are looking for expenses prepaid and income owing. So income owing is there, but this is expenses owing. Option A is incorrect. Then we have expenses owing, again incorrect. Then we have expenses prepaid, that's the one we're looking for, and income owing. This is correct. Now for the credit balances, we are looking for expenses owing and income received in advance. So we have expenses owing and income received in advance on the credit side as well. So option C will be our correct answer. Now for question number 14, a business prepared its statement of profit or loss for the year ended 31st December. During that year, on 30 April, a non-current asset had been sold. The following information is available in respect of this item. We have been given the cost, the sales proceeds, residual value, carrying value at 1st January, expected life. Non-current assets are depreciated using the straight line method, with depreciation being charged for each month of ownership. No accounting entries had been made in respect of this non-current asset for the year ended 31st December. What was the effect of this omission on the profit for the year? Okay, so we're looking at the recording of the disposal of non-current asset, but only on the profit for the year. And while calculating profit for the year, we prepare the statement of profit or loss, in which we would record the depreciation amount as well as the profit or loss on disposal. Okay, so let us first calculate the depreciation amount. In this case, we know that in the year of disposal, we had used this non-current asset till 30 April. So that will be for the months of January, February, March and April. We need to calculate the depreciation for these 4 months. And we are utilizing our straight line method. So we can start with a cost of 130,000. Then we can subtract our residual value of 10,000. Then divided by the expected life of 8 years, but this would give the depreciation charge for 12 months, and we only require it for 4 months, which is why we will be applying our unitary method. So we just multiply it by 4 divided by 12. This gives the depreciation charge for the year of 5,000. Then we also need to figure out whether there was a profit or loss on disposal. We have the carrying value at 1st January, but we need the carrying value on 30 April, which means that from this amount, we just have to subtract the depreciation charge for the year of 5,000. This results in the value of 47,500. And the sales proceeds is 53,500, which means that we received higher than what we anticipated for. So there was a profit on disposal. That will be the difference between sales proceeds and our carrying value. So that's 53,500 minus 47,500, which results in 6,000. Okay, so 6,000 would have been an income, right? So we add the 6,000 and the depreciation would have been an overhead. So we subtract the 5,000. So the total entry in our statement of profit or loss for this non-current asset would be positive 1,000. But we did not include it, which means that the profit of 1,000 would be understated. So that's the answer we're looking for, 1,000 understated, which is given in option A. Now for question number 15, the owner of a trading business prepared draft financial statements for the year ended 31st December. It was then discovered that the following transactions occurring during the year had not been recorded. Okay. Which transactions will affect both the gross profit for the year and the total value of net assets on the statement of financial position? Okay, we're looking for items that would affect the gross profit and the net assets on the statement of financial position. For the first one, a check for 500 had been received for commission earned. Okay, so this might be a bit tricky because the commission receivables would have already been entered as part of the current asset, right? Because that's a receivable, and the check, it can just be transferred to our statement of financial position under the heading of bank, which would again be recorded under our current asset. So 500 will now be subtracted from the commission receivables and will be added to the bank. So overall, there will be no changes within the current assets. That's why this will have no impact on the gross profit as well as the net assets on the statement of financial position. For the second one, cash amounting to 2,900 was received for a sale of goods which had cost 3,000. So this will definitely impact our gross profit because 2,900 will now be added to our revenue. Then 3,000 would be subtracted from the closing inventory. That is why the second transaction is what we're looking for in this case. Then for the third one, inventory costing 5,000 had been taken from the business by the owner for personal use. Again, this will have an effect on gross profit because this 5,000 will be subtracted as part of the cost of sales as goods taken for personal use. Then for the fourth one, non-current assets with a carrying value of 6,500 had been sold for 7,000 cash. And remember, this would have resulted in a profit on disposal, which would affect the profit for the year. But in this case, we're only looking at the gross profit, right? So this will have no impact on gross profit. And regarding the net assets, And regarding the net assets as well, there will be no change because we have now received 7,000 cash. So 7,000 cash would be added to current asset. Then 6,500 would be subtracted from our non-current asset. And the remaining 500 would be shown as part of the profit for the year within our capital. So in total, there would be a balance within our accounting equation, right? So there will be no change in the value of net assets. So the correct answer we're looking for should have 2 and 3, which is given by option C. Now for question number 16, a business sells some inventory for 80 on credit. This originally cost 50. How does this affect the statement of financial position? So we're looking at the effect in our current assets and owner's capital. Okay, so in this case, we can see that the cost was 50 and we sold it for 80, which means that there was definitely profit. And the profit was of 80 minus 50, which is 30. And remember, profit is always added to the owner's capital, which is why this profit of 30 will increase the owner's capital. So we're looking for increases by 30, which is given in B and D. Then within our current assets, remember that this is sold on credit, which means that this 80 will now act as the receivables. And the receivables will be recorded as part of our current assets, right? But also remember that we already had the inventory of 50. Now the inventory of 50 would be subtracted from the current assets and new receivables of 80 will be entered, which means that overall there will be a positive 30 change within our current assets. So we're just looking for increase by 30 for the current assets as well. That is given by C and D, and the correct one for current assets as well as owner's capital is given by option D. For question number 17, which entries were made to record the interest on capital in partnership accounts? Okay, so remember that we create an appropriation account in order to enter all of the interest on capital, interest on drawings, as well as salaries. And then those three headings will again be adjusted as part of the partner's current accounts. So we're basically looking for appropriation account and current account. Now let's talk about the sides. In this case, we're talking about interest on capital, which will be received by the partners, right? And within our current account, anything that will be received by the partners will be entered on our credit side. Anything that the partners will have to pay to the partnership business will be recorded on the debit side, right? So we're looking for the current account credit side and the appropriation account debit side. That is given by option B. Now for question number 18, L and M are in partnership, sharing profits and losses in the ratio 3:2 respectively. For the year ended 31st March, their statement of profit or loss showed a profit for the year of 68,000. The following information relates to the partnership for the same period. We have interest on loan from L. We have total for both partners, interest on capital, interest charged on drawings, as well as salaries. How much of the residual profit will L receive? So we first have to figure out the residual profit, and in this case we will just be following the format of our appropriation account. So we start with the profit for the year of 68,000. Then we have to adjust these three. So the interest on capital is something that the partnership will pay to the partners, which means that this will reduce the residual profit. So we have to subtract 2,600. Then we have the interest charged on drawings. This is something that the partnership will receive from the partners. So this will increase the residual profit, which is why we have to add the 1,200. Then we have the salaries of 20,000. And remember, salary is something that the partnership will pay to the partners, which is why this will also reduce the residual profit. So minus 20,000. This gives the residual profit to be of 46,600. Now let us calculate the residual profit that L will receive. So in this case, we have the profit sharing ratio of 3:2, where 3 is the portion for L. So we just start with the residual profit that we calculated, 46,600, multiplied by the appropriate ratio. In this case, the total is 5 portions, and out of 5 portions, 3 belongs to L. So times 3 by 5, which will result in the amount of 27,960. This is the answer we're looking for, which is given in option C. Now for question number 19, which reserves are revenue reserves? So revenue reserves are the reserves created by retained earnings and the day-to-day operations of the business. The first one is general reserve. Remember that general reserve will be created by transferring a certain amount from the retained earnings. And retained earnings has the profit for the year, which is created by the day-to-day activities of the business, which is why this is a revenue reserve. Then we have retained earnings. Again, the same reasoning as above. This is a revenue reserve. We have revaluation reserve. So revaluation reserve will be created by revaluing a non-current asset upwards or downwards, right? And we're talking about non-current asset, which is why this will be classified as capital reserve. So this is not what we're looking for. And we have the share premium account. This will be created when the shares will be issued at a higher value than its nominal rate. We're talking about capital in this case, which again classifies as capital reserve, not the revenue reserve. So this is incorrect. The correct answer should include 1 and 2, which is given in option A. Now, for the 20th question, a limited company has the following in its statement of financial position at 31st March. We have the ordinary share capital, retained earnings, and share premium. Ordinary shares have a par value of 0.40 each. A bonus issue is made on the basis of 3 shares for every 8 shares held at 31st March. The issue is made so that the reserves are kept in their most flexible form. What are the balances on the reserve accounts after the bonus issue has been made? Okay. So we are providing 3 new bonus shares for every 8 existing shares. So for 8 ordinary shares, we will be providing 3 bonus shares. The first thing that we need to calculate is the number of existing ordinary shares. We already have the value of ordinary shares right here, 200,000. And whenever we're trying to calculate the number, we just need to divide the value by the nominal rate, which is given right here, 0.40. This results in 500,000. So we have 500,000 ordinary shares. Now we need to figure out the number of bonus shares for these number of ordinary shares. For 500,000 ordinary shares, the company will provide 3 by 8 times 500,000 bonus shares. That is 187,500 bonus shares. And remember, bonus shares will be issued at the par value, right? So let's calculate the value of bonus shares. We start with the number of bonus shares, 187,500. multiplied by the nominal rate of 0.40, which results in the value of 75,000. Okay, and the bonus shares will be funded by the reserve itself. So we'll be utilizing the retained earnings and share premium. And in this case, we are told that the issue is made so that the reserves are kept in their most flexible form. It means that we first utilize our share premium, then if it's not sufficient, we move towards retained earnings. In this case, we can see that the share premium is 80,000 and 80,000 can easily sustain the value of 75,000, which means that after the bonus issue, share premium will have 80,000 minus 75,000, which is 5,000. And the retained earnings will have the entire amount of 82,500. That's the answer we're looking for, 5,000 and 82,500, which is given in option C. For the 21st question, a company has calculated inventory turnover periods for 2 successive years. So we have 90 for year 1, 120 for year 2. We can clearly see that inventory turnover in days has increased. Now, the company directors have suggested the following reasons for the change. We need to figure out the possible reasons for the change. Okay, for this one, we first need to know what's the formula for inventory turnover in days. That's average inventory divided by cost of sales multiplied by 100%. Okay, and we're looking at the impact of purchases and sales. Remember that since we're looking at the increment in inventory turnover, either the average inventory should increase or the cost of sales should decrease, right? And average inventory is just opening inventory plus closing inventory by 2. So it means that both the opening and closing inventory should increase for the average inventory to increase. And then we have cost of sales. So cost of sales is just opening inventory plus purchases minus closing inventory. So for this to decrease, we want the closing inventory to increase since this is a negative term. And we want the purchases and the opening inventory to decrease. Okay, so for both the average inventory and cost of sales, we've concluded that the closing inventory should increase, right? And the closing inventory has a direct relation to sales. So if the sales increases, then it means that closing inventory will decrease. It just means that we will have lower inventory at the year end that is yet to be sold. But if the sales decreased, then the closing inventory would increase. And this is the criteria we're looking for in this case, which means that the sales should decrease, which is given by the third one. As for the purchase, we require it to decrease so that the overall cost of sales can decrease and the inventory turnover in days can increase. That's given in the first one. So the correct answer we're looking for should have 1 and 3, which is given in option A. Now for question number 22, the following information is available for a business at the end of its financial year. We need to calculate the trade receivables turnover. So the formula is quite simple. We just divide the trade receivables by the credit sales multiplied by 365. The trade receivables in this case is 16,000. The credit sales is given as 220,000 times 365. This will result in the value of 26.55. And remember, whenever we're calculating days, we have to round it up. So that will be 27 days. This is given in option B. Now for question number 23, a business commenced trading on 1st January. The purchases and sales of inventory for January were as follows. The business used the first in first out method of inventory valuation. We need to figure out the gross profit for the month of January. Okay, we have the purchases as well as sales in this case. And since the business commenced trading on 1st January, it means that there was no opening inventory in this case. So the opening inventory will be 0. Now let us calculate the purchases. So the purchases on 1st January is 3 at 200 each. So 3 times 200. Then the purchases on 26th January is 3 at 250 each. So 3 times 250. This gives the total purchases to be of 1,350. Now let us also calculate the sales value. On 13th January, it was 2 at 400. And on 28th January, it was 2 at 400 again. So this will result in 1600. Now the only thing remaining will be the calculation of closing inventory. Okay, so remember that this is the first in first out inventory valuation method, which means that the purchases made at the earlier date will be used first to make the sales. Now we made 3 purchases on the date of 4th January, and out of these 2 were used on 13th January. So we still have 1 remaining purchase made on the 4th of January. Then we made additional purchase of 3 units on 26th January. Then on 28th January, we again sold 2 units. So out of these 2 units, one will be the unit bought on 4th January. Then the other one will be the unit bought at 26th January. This means that from the purchases made on 4th January, nothing is remaining now, since out of 3, 2 went to the sales in 13th January and 1 went to the sales in 28th January. And for the purchases made in 26th January, out of 3, 1 was used for the sales in 28th January. So 2 units are still remaining. So the closing inventory is the 2 units purchased on 26th January at the cost of 250 each. This will result the closing inventory to be 500. Now let's calculate the cost of sales. So opening inventory is 0, purchase is 1350, and the closing inventory is 500. This gives the cost of sales of 850. Now gross profit is just sales minus cost of sales. That's 1600 minus 850, which results in the value of 750. That's the answer we're looking for, which is given in option D. Now for the 24th question, a company has been asked to quote a price for a specific job. Estimated costs are as follows. So we have the direct materials and direct labor. Overheads are charged at 50% of labor cost. So 50% of labor cost is 3300 times 50%, which results in 1650. Then profit is 20% of the total job cost. We need to figure out the total of the quotation for the job. Let's figure out the total job cost. We have the direct materials of 2000. We have the direct labor of 3300. Then we have the overhead of 1650. This results in the total job cost to be of 6950. Now, in order to calculate the total of the quotation, that's just the sales price, right? We have to incorporate the profit of 20%, and the profit is to be charged on the total job cost. So we start with the total job cost of 6950, increase it by 20%. This results in the value of 8340. That's the answer we're looking for, which is given by option D. Now for question number 25, a manufacturing business has a service department X and production departments Y and Z. Department Z is labor intensive. Okay, how is the overhead absorption rate set for department Z? Okay, we just have to figure out the task and order it. Now the first task whenever we calculate overhead absorption rate is to figure out the total overheads for each of these departments X, Y and Z. Then the second task would be to reapportion the cost of the service department to 2 production departments, right? Then since we know that department Z is labor intensive, in order to calculate the overhead absorption rate, we would have to divide the total overheads for Z department by the number of direct labor hours. That's what we're looking for. So the first one is apportion total overheads across X, Y and Z, which is given by option A and option B. Then the second task is to reapportion X's overheads to Y and Z, which is again given by option A and option B. And the final one is to divide Z's overheads by our labor hours. And Okay, the difference here is the budgeted and the actual labor hours. So remember, whenever we calculate the overhead absorption rate, we always use the budgeted data, not the actual data. So option A would be correct in this case. Now for question number 26, what would cause overheads to be underabsorbed? Remember that there are two criteria for underabsorption. The first criteria is that our budgeted overhead is less than the actual overhead, and the second one is the budgeted production is greater than the actual overhead. So these are the actual production. These are the two criteria we're looking for. For the first one, we have overhead absorbed is greater than overhead budgeted. This is incorrect. We're not comparing between overhead absorbed and overhead budgeted. We are comparing between the overhead absorbed and the overhead incurred. That's the same reason why option B will also be incorrect. Then overhead incurred, that's the actual overhead, is greater than overhead absorbed, that's the budgeted overhead. And that's the exact criteria we're looking for in this case, which is why option C will be the correct answer. Now for question number 27, a business produces two types of product, P and Q, for the month of January. Overheads are absorbed using direct labor hours, and the production details are as follows. We have the units manufactured and sold, as well as the direct labor hours per unit. Direct costs for the month were 23,750, and the fixed overheads were 6,500. We need to calculate the overhead absorption rate per hour. Alright, so we already have the overhead right here. We just need to divide it by the total direct labor hours. And we need to calculate the direct labor hours for both the products. So for product P, that would be the total number of units multiplied by the direct labor hours required per unit. Because one unit would require 1.5 hours, it means that 5,000 units would require 5,000 times 1.5 hours. We need to repeat the same process for Q as well, so 2,000 times 1. This results in 9,500 hours. Now the overhead absorption rate per hour will be our overhead, 6,500, divided by our direct labor hours of 9,500. This results in a value of 0.68. That's the answer we're looking for, which is given in option A. Now for the 28th question, which statements about marginal costing are correct? The first one is contribution is the difference between sales revenue and total production cost. This is incorrect because contribution is the difference between sales revenue and total variable production costs. Then the second one is costs are classified as variable costs or fixed costs only, which is true. And the third one is variable costs include variable selling expenses, which is also true because this is variable in nature, right? So the correct answer we're looking for is 2 and 3, which is given by option D. Now for question number 29, the following information relates to a manufacturing business. We have been given the production for the period, closing inventory, direct materials cost, direct labor cost, and factory fixed expenses. There was no opening inventory. Now the closing inventory is valued using marginal costing. What is the marginal cost per unit of the finished goods? Okay, since we are using marginal costing, we need to divide the variables. We need to divide the overheads as variable and fixed, right? In this case, we have direct material costs and direct labor costs, which are the variable costs, and we have fixed factory expenses. So these are the variable costs. And since the closing inventory is valued using marginal costing, the closing inventory will only include the variable cost, right? Okay, so let us first figure out the total cost or the total variable production cost. This will include the direct materials cost and the direct labor cost. So 12,000 plus 6,000, which results in 18,000. And in this case, since we are asked to calculate the marginal cost per unit of the finished goods, we just have to divide the total variable production cost by our production for the period. So that is just going to be 18,000 divided by 2,400, which results in the value of 7.5. That's the answer we're looking for, which is given by option A. Now for the 30th question, which statement reflects how cost volume profit analysis can help with management decision making? Let's take a look at each of the options. For option A, we have separating out fixed and variable elements of cost. That is done by marginal costing, not cost volume profit analysis. So this is incorrect. The second one is setting short-term prices. This is true because cost volume profit analysis will go over the adequate cost and the volume that will be required in order to get a certain amount for profit. So this will definitely help in setting the prices or the selling prices of our goods. So option B is the correct one. Let's take a look at the remaining options as well. Understanding changes in the business environment. So remember, the cost, volume, profit analysis will only consider three things: the cost, the volume, as well as the profit. So business environment is not taken under consideration, which is why this will be incorrect. Then the fourth one is understanding changes in the product mix. Again, the cost, volume, profit analysis can be done on a single product, not on an entire product mix, which is why the fourth option is also incorrect. Okay, this concludes the paper 1-2. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.